Alright, so we have come to the next step in accounting cycle, which is to prepare the trial balance. Okay, so what are the purpose or objective of preparing the trial balance? So the first one is to check arithmetical accuracy. Okay, whether we have calculated, alright, the balances, okay, or whether we have calculated the amount in the accounts, okay, correctly or not. All right, because when we prepare the trial balance, if debit balance do not agree with the credit balance, or the amount are different, okay, the amounts of debit and credit are different. All right, so we can detect, okay, we can detect, all right, which comes to the next objective. We can detect errors or mistake. All right, okay, all right, and then the last objective is to facilitate or to help the preparation of the financial statements, because the trial balance, in the trial balance, we list down all the accounts, all right, that we have recorded earlier. Okay, so we can from there we can see that, okay, which accounts, all right, to be recorded or to be disclosed in the statement of financial position, and which accounts is to be disclosed in the statement of financial in the statement of profit or loss. All right, okay, all right, about the errors in the trial balance. All right, so we talk about the errors, all right, from the computation, okay, or from the principles. Okay, it could be different errors. All right, so these errors, okay, can either affecting the trial balance or not affecting the trial balance. What does it mean? Okay, affecting trial balance meaning that we can see the error from the balance of debit and credit. If there is a disagreement between debit balance and credit balance, then it means that the error affecting the trial balance. Okay, if, okay, when we look at our trial balance, okay, debit and credit agree with each other. Okay, we get the same amount, okay, for debit and credit. All right, so we don't see we cannot see the errors directly, all right, from there. All right, so there are errors that not affecting trial balance. Okay. All right, and the last part for the trial balance, we're going to look at the format. All right, and what are the steps to prepare the trial balance. Okay, now we are looking at the errors that affect the trial balance, meaning that, okay, the debit balance do not agree with the credit balance, or debit are not the same as credit balance. Okay, all right, so one of the reason for the errors that affecting trial balance is the single entry. This is where for a business transaction you record only either debit or credit. All right, because for a business transaction you must have at least, okay, debit and credit. All right, at least one debit, one credit. All right, so this is a single entry, meaning that you record either one, all right, either debit or credit. All right, okay, so what happened at the end of the day? Okay, there will be a difference between debit and credit balances in the trial balance. All right, so the next one is error of transposition. Okay, debiting and crediting accounts with different amount. Okay, let's say for example, the business started with 35,000 ringgit cash. Okay, all right, so the correct entry should be to debit cash, okay, 35,000 ringgit, and to credit capital 35,000 ringgit. But maybe due to honest error and mistake, okay, you debit cash 35,000, but then when you record in capital account, okay, you record only 25,000. Okay, so at the end of the day, what happened is, okay, the debit balance, okay, will not be the same as per credit balance. All right, okay, and then another error, it could be due to error in addition, okay, where you wrongly add the total of debit balance or the credit balance. Okay, the other reason is posting to the incorrect side of an account, right? Posting to the incorrect side of an account. This is where the debit or credit entry is posted to the wrong side of the account. All right. Okay. For example, okay, I'm using the same example. For example, you should debit cash, okay, and then credit capital. But you could on the debit, you could probably debit both. Okay, debit cash and then you debit capital. Okay, you post to the wrong side of the account. So at the end of the day, what happened? Okay, the the debit balance will not be the same as credit balance. Okay, all right. And then if there is any error in the try balance, it could be error when you miscalculate or when you wrongly transfer the amount from the ledger entry, okay, to the try balance. Okay, all right. There will be some mistake, all right, in the number that you transfer. Okay, all right. Let's look at the next one. All right, so let's look at the next one. Okay, errors not affecting try balance. When we prepare the try balance, we may get the same amount of debit balance and credit balance. All right, but there might be errors in the try balance that we cannot see directly from the balances of try balance. All right. Okay, so the error not affecting try balance. Okay, the first one is error of omission, where you completely omit, okay, or where you completely left out the transaction from the books of accounts. Okay, you did not record at all. All right, so it won't affect the debit and the credit balance. All right. Okay, and then the second one is error of commission. Error of commission is where you record the amount correctly. Okay, you post the amount correctly uh, to the ledger accounts, okay, but you post to the wrong account of the same category, okay, to the wrong account of the same category. Okay, let's say for example you have two account receivable. What is an account receivable? Current asset. Current asset under which category? Asset. All right, so you have two account receivable. One is account receivable Ahmad, the other one is account receivable Ahmed. Okay, the difference is only maybe in the spelling of the names. All right, Ahmad and Ahmed. All right, okay, so let's say for example Ahmad made a payment to the business, okay, for the money that he owed to the business, but when you record the amount received, okay, instead of you deduct from Ahmad account, you deduct in Ahmed account. They are still in the same category, which is asset, okay, but to the wrong account, okay, but the amount is correct. Okay, the amount is correct. Okay, maybe you receive cash, so you debit to cash correctly, okay, but when you credit, okay, you credit to the wrong account but with correct amount. Okay, all right, next is error of principal. Okay, error of principal is where correct amount is posted to the wrong account of different category. Okay, correct amount is posted to the wrong account of different category, but it won't affect the debit and credit. Okay, for example, okay, asset and expense. Okay, the principles to debit and credit for asset and expense, it will be the same. Okay, it will be the same. All right, let's say for example you you purchase a stationery. So stationery is expense. Okay, stationery is an expense account. All right, so you but you did not record as stationery, okay, which should be in expense, but you record as office equipment, okay, which is an asset. All right, you record everything correctly except that, okay, wrong account and in a different category. It should be in stationery, but you record in office equipment. One is expense, one is asset, but we did not notice but we cannot see the error from the try balance because the category of this asset are of the same side, okay, asset and expense. Okay, all right, and then complete reversal of entries. Okay, complete reversal of entry is a common mistake, okay, for example that were made by the student, okay, where you let's say for example instead of you debiting cash account for increase in asset, but increase in asset you should debit, okay, for example increase in cash, so you should debit cash, but instead of you debit cash you credit cash, and then you maybe you debit sales. Okay, so complete reversal entries, it should be debit cash credit sales, but you debit sales credit cash. Okay, correct amount, okay, only the reversal of entries. Okay, so at the end of the day we still cannot see we cannot detect the error from the try balance. Okay, the next one is compensating error. This is where the error on the debit side is compensated by the same amount in the credit side. It happened coincidentally. All right, okay, and error of original entry. Error of original entry meaning that the error made starting from the journal entry, starting from the record in the journal entry, you you posted from the journal entry to the ledger, and then from the ledger you transfer to the trial balance. Okay, so everything is being consistent, except that maybe there's an error in the original entry where maybe you recorded wrong amount, or you recorded wrong account. Okay, all right. Okay, so that's all for the errors not affecting the trial balance. Okay, so this is the format, okay, for the trial balance. All right, so basically we are going to start with, okay, there are step one, okay, start with the name of the business. All right, step one is to start with the name of the business. So it is important that you state the name of the business. Sometimes marks will be given, okay, for the format. All right, okay, so number one is to state the name of the business. Number two, the title of the statement. Okay, so the trial balance as at, okay, for example, okay, so you have to state the accounting closing date, okay, for example, on 31st December 2020. Okay, and then we are going to have a column for name of account, column for debit, column for credit. All right. Okay, so name of account is the name of the account. All right. So debit is the debit balance, and credit is the credit balance. Okay, so I give you an example here. Okay, for step number 3. Okay, so we have cash account. So the first thing that we are going to do is to transfer the name of the account. Okay, so cash. Alright, and the next step is, okay, to transfer the balance. Okay, so in this case we have a debit balance, so I hope you still remember, and then you understand that the difference between debit balance, credit balance, and zero balance. Okay, what is debit balance, credit balance, and zero balance? Okay, so debit balance is usually on the debit balance is referring to the balance CD, okay, on your right hand side. Alright, like this one, balance CD on your right hand side. That one is called debit balance. Why it is called debit balance? Because when we started, okay, the business again in the following month, all right, we are going to carry this amount. Okay, we are going to carry this amount. So it shows that, okay, so it shows that this business still has cash, okay, of 3,000 for the next month. All right. Okay, so we're going to bring this to here. So this is why it is called a debit balance. So when you transfer to the trial balance, you have to transfer that on the debit side. Okay, you have to put that 3,000 on the debit side because it is a debit balance. All right. Okay, whereas for accounts with credit balance, then you have to put on the credit column. Okay, in the credit column. Okay, so step 4. Okay, accounts debit balance is to be recorded in debit column of trial balance, vice versa. All right, and then the step number 5. Step number 5 is to calculate the total of debit and credit. So this is where we can see whether we have any error or not. Okay, to check the arithmetical accuracy. Okay, to detect any errors, and at the end of the day, the preparation of the trial balance will help us with the preparation of final accounts or financial statement. Right? Okay. Okay, so the last part of this topic is the financial statements. Okay, common practice in the business is to end its accounting period every 12 months. So this is very common that at the end of 12 months, then we are going to close our books of account. All right. So what will happen at the end of the accounting year? What should we do? Number one is to balance of account. Okay, meaning that we are going to close all account. Okay, and then to prepare a trial balance. Okay, because we want to see if there is any mistake, okay, or errors in the preparation of our ledger accounts. Okay, and then number 3, assuming, okay, there is no error and mistake in the trial balance. Okay, no error and mistake in the trial balance, because if there is any error or mistake in the trial balance, then we have to prepare an adjusting entry. Then we have to go to we are going to repeat again the process where we are going to prepare a journal entry, post it to the ledger, and then re-prepare the trial balance. Okay, and then check again. Okay. Okay, so but now we are assuming there is no error and mistake in the trial balance. So what happened after that? Okay, we are going to close all nominal or temporary account. Okay, so what are the nominal or temporary account? They are referring to revenue and expenses account. Okay, so basically, in 5 accounting classification that you have learned before, okay, 2 out of it are temporary account and 3 out of it are permanent account. Okay, so revenue and expenses are temporary account, while asset, equity, and liability are permanent account. All right, so what are we going to do with this temporary account? We're going to close, and then we're going to transfer all the balances to statement of profit or loss. Okay, while all the balances in asset, equity, and liability accounts are to be disclosed in statement of financial position. Okay, we are not going to close, okay, asset, equity, and liability account. We are going to show only balance CD. All right, and then this balance then will be disclosed in statement of financial position. Unlike temporary account, we are going to close that account. Okay, all the balances. Okay, instead of recording them as balance CD, now we are going to transfer to. Okay, we are going to transfer them. We are going to debit the account or credit the account depending on the types of account, either revenue or expense. Okay, and then the amount will be transferred to the statement of profit or loss. All right, so what do we have here? We have statement of profit or loss and the statement of financial position. Okay, so in the statement of profit or loss, we are going to record the items of revenue and expense, while in the statement of financial position, we are going to disclose, okay, of the asset, equity, and liability. All right, okay, so from the items of revenue and expenses that we record in the statement of profit or loss, we are able to see whether at the end of the year the company earned profit or suffer the loss. Okay, at the bottom of the statements. All right, whereas for the statement of financial position, this is for us to see the position of our asset, equity, and liability. And even from this statement, we are able to see whether we finance our asset or we run our business by using liability or honest equity. Okay, all right. Okay, so how do we prepare the statement of profit or loss? Okay, so statement of profit or loss will start from the sales. Okay, and then we are going to deduct any accounts, okay, that will reduce the sales. Okay, so we may have here sales return and also discount allowed or sales discount. Okay, all right, and then we are going to deduct cost of sales. Okay, so cost of sales. So how to calculate cost of sale? Cost of sale is equal to opening inventory plus purchases. Okay, and then we are going to minus any account that will reduce the purchase, which are purchase return and discount received or purchase discount. Okay, and then we have here carriage inwards. Okay, duty on purchase, insurance on purchase. Okay, all together they are equal to cost of goods available for sale. All right, and then we're going to minus or less closing inventory. So this is how we calculate cost of sale or cost jualan. All right, okay, so this is how we will calculate cost of sale, and the total cost of sale here, and this is the total of net sales. Okay, so we are going to deduct cost of sales from the sales, and then we get gross profit. So we have here gross profit. Okay, gross profit or gross loss. Okay, untung kasar, rugi kasar. All right, and then we are going to add other income. Okay, if any, let's say for example, you rent out a part of the building and you receive a rent. Okay, so here we are going to record rent received. Okay, if there is any commission received, interest received, dividend received, fees, royalty, okay, any other income that you receive, then you disclose here. Okay, and then we are going to minus operating expenses. Okay, our main expense account is purchase. Okay, but other than purchase, we do have other expenses that we have to take into accounts. Okay, that we have to take into consideration when we calculate our profit or loss. Okay, what are the examples of operating expenses? Okay, the examples does not limit to this only. Yeah. Okay, the expenses does not limit to this example only. Okay, so from this example, we have salaries and wages, insurance, printing and stationery, rent expense, interest expense, repairs expense, and carriage outwards. All right. So if some of you notice that we have carriage inwards, okay, and carriage outwards. So what is the difference? So basically, carriage is referring to the transporting of goods in and out of the business premise. Okay, carriage inward meaning that you incur costs, okay, to carry the goods from the supplier to your business premise. While carriage outward, this is where we transport the goods from our premise to the customer premise. Okay, all right. Okay, so let's look at the statement of financial position. So we already discussed previously on the format of the statement of financial position. Okay, where we are going to start with asset. Okay, and then the asset will be divided into non-current asset and current asset. And then we have to disclose every item under non-current asset and current asset. This is why it is important that in the recording process, we specify the name of the accounts so that we know what types of asset that we are recording here. Okay, if we record everything as asset, meaning that you are going to show here only one item, which is asset. No, we are not going to do that. So we are going to specify, all right, the name of accounts. Okay. All right, and then finance by owner's equity. So owner's equity, how to calculate this one? Capital plus minus profit or loss minus drawings, if any. Okay, and then equal to capital or owner's equity at the end of the year. All right, and then after that, it is followed by non-current liabilities. Okay, and current liabilities. So this is where you show your financial obligation, whether you are going to repay them within 1 year or more than 1 year. All right. Okay.